Hey everyone, welcome back to VOLPROFIT Academy. I'm really glad you're here because today we're diving deep into the world of trading. And I don't mean just the shiny Instagram version of trading, where people show Lambos and charts with 100 indicators you don't even understand. No, I mean the real stuff. The foundations, the concepts, the mindset, and some practical strategies you can actually use. And don't worry, I'll try to make it fun. I know trading can get a little heavy, but trust me, if you stick with me for the next half an hour, you'll come out of this session with much more clarity than most people who've been trading for years. So let's start with the very basics. What is trading? At its core, trading is simply buying and selling assets. Stocks, forex, commodities, cryptocurrencies, whatever. You buy something at one price and you sell it at a higher price, or if you're shorting, you do the opposite. That's it. Sounds simple, right? And that's the first trap. Because if it was really that simple, everyone would already be rich. But in reality, markets are driven by psychology, emotions, greed, fear, and a little bit of madness. So as a trader, you're not just battling numbers on a chart, you're battling your own brain. Now let's talk about the main concepts you have to understand. First, risk management. If you ignore this, you're basically gambling. Imagine walking into a casino and putting your entire salary on red. That's what many new traders do. They put too much money on one trade, they get emotional, and when it goes against them, they panic. A smart trader never risks the whole account. Instead, you manage risk by deciding before the trade. How much are you willing to lose if this goes wrong? Professional traders often risk only 1 or 2% of their account per trade. That way, even if you lose 10 times in a row, you're still in the game. Because here's the thing, trading's not about winning every single trade. It's about surviving long enough to let probabilities play out in your favor. Think of it like this. If you flip a coin and it's 50-50, heads or tails, you don't know the outcome of one flip. But if you flip the coin 100 times, you'll see the probabilities balance out. Trading works a little like that. You don't know what's going to happen on one specific trade. But if your strategy has an edge, meaning it wins slightly more than it loses, then over many trades, you'll come out ahead. Let me give you a funny but true example. Imagine you're trying to catch fish with your bare hands. You're standing in the river, and you know you're not going to grab every fish that swims past. You'll probably miss more than you catch. But if you keep your hands in the water long enough, eventually you'll catch enough to feed yourself. Trading's the same. You don't need to win every time. You just need to have the patience and discipline to let your edge play out. Now, another key concept is technical analysis. This is basically reading the charts. Price action, candlesticks, support, resistance, trends. All those lines you see traders drawing on TradingView, that's technical analysis. But let me give you a warning. It's very easy to get lost here. Some traders have more lines on their chart than an airport radar system. It looks impressive, but most of the time it's just noise. Keep it simple. Look for trends, look for levels where price has reacted before, and pay attention to volume. The simpler your chart, the easier it is to make decisions. On the other side, we've got fundamental analysis. This is when you look at the actual news, the economy, company earnings, interest rates, inflation numbers, all that fun stuff. For example, if the US Federal Reserve raises interest rates,
Good afternoon.
You can expect the dollar to strengthen. If a company announces record profits, its stock might go up. Fundamentals can move the market in big ways, while technicals help you time your entries and exits. Ideally, a smart trader uses both. Let's not forget psychology. Honestly, this is probably the most important part of trading. If your head isn't right, you're going to blow your account no matter how good your strategy is. Greed will make you hold on to trades too long. Fear will make you exit too early.
FOMO.
The fear of missing out will make you jump into trades that you should have avoided. And revenge trading, oh boy, that's the killer. That's when you lose a trade, get angry, and immediately place another trade to win it back. Spoiler alert, it usually ends badly. The market doesn't care about your feelings. It's not your girlfriend, it's not your mom, it's not your friend. It's just there, cold, indifferent, waiting for you to mess up. So how do you deal with this? You create a trading plan. A plan is simply a set of rules you follow every time, no matter what. For example, you might say, I only trade during the London and New York sessions. I only risk 1% per trade. I only trade when there's a clear trend. And I always set a stop loss. Then you stick to that plan like a pilot follows a flight checklist. You wouldn't want your pilot improvising mid-flight, right? Same thing with trading. Think of your trading plan as a diet. You know how people say, I'm going to eat clean, no junk food, just healthy stuff. And then after 2 days, they're at midnight eating a pizza. Yeah, that's how most traders treat their trading plan. They're disciplined for a while, and then one night, they look at the chart, see Bitcoin pumping, and say, just this one time. Next thing you know, they've blown their account. So stick to the plan. Let's also talk about strategies. There are a ton of them: scalping, day trading, swing trading, position trading. Scalping means you're in and out in minutes just taking small moves. Day trading means you open and close within the same day. Swing trading means you hold for days or weeks, catching bigger moves. Position trading means you're basically investing long term. Each style has its pros and cons. If you have a lot of time to sit in front of charts, scalping or day trading might work. If you have a job and can't watch the screen all day, swing trading's probably better. There's no best strategy. There's only the strategy that fits your lifestyle and personality. Here's an example. Imagine two traders. Trader A has all day free. He loves staring at screens, drinking coffee, and catching quick trades. He's a scalper. Trader B works 9 to 5, has kids, and can only check charts once or twice a day. If he tries scalping, he's doomed. He'll miss signals, get frustrated, and probably quit. But if he swing trades, placing trades that last for days, it matches his life. So the moral is, don't just copy someone else's strategy. Find what works for you. Another important concept is journaling your trades. Yeah, I know it sounds boring, but trust me, it's like keeping a diary for your trading. Write down why you took the trade, what happened, and how you felt. After a month, you'll see patterns. Maybe you'll realize you always lose when you trade late at night when you're tired. Or maybe you notice you win more when you follow certain setups. A trading journal is like a mirror. It shows you the truth about yourself as a trader. And finally, patience. Trading is a marathon, not a sprint. The market will always be there. Don't rush, don't force trades. Some of the best trades you'll ever make are the ones you didn't take. Because not losing money is also winning. So to wrap it up, trading is a game of survival, discipline, and probabilities. Learn the concepts, manage your risk, keep your emotions in check, and find a strategy that fits your life. And don't forget to laugh at yourself along the way, because trust me, you'll make mistakes. Everyone does. The goal is not to be perfect. The goal is to improve and stay in the game long enough to profit. Thanks for sticking with me. This was VOLPROFIT, and I'll see you in the next session. Stay sharp, stay disciplined, and don't blow your account.